Hey everyone, welcome back to another video. In today's, we're going to continue the topic of time value of money concepts. In particular, we're going to dive into compounding and discounting and how it relates to commercial real estate. Let's get started. So first on the agenda, we're really just going to describe what time value of money is, right? So that we have a starting point. And then we're going to talk about two fundamental concepts of the time value of money. First, we're going to talk about discounting, like what that means as we translate dollars from the future to the present. And then the opposite, we're going to talk about compounding as we find ways to translate dollars from the present to the future. So just by way of background, what really is the time value of money? And this is one of the methods or methodologies or principles that we use that helps us kind of quantify the relationship between the future and the present, or vice versa. And so as we think about moving across time with dollars, it's important for us to keep in mind that there is a value component here for us to think about. So let's imagine you have dollars today, year one, like right now you have dollars. But if you were to invest them wisely, right? Like what do you think those dollars could be worth 30 years from now? That is a core component of the principle of the time value of money, how we think about growth of investing, right? But if we can move in one direction, so let's say into the future, we could just as easily move from the future to the present, so going backwards. So we could say, all right, if you had collected $3 million a couple of years from now, what is that really worth today? So as we think about real estate context of the time value of money, it really helps us answer questions about investing, financing, and valuation. So some of the typical questions we can come across are, what's my loan payment on this loan? What is this investment worth? How much loan do I have left to repay a couple years into the life of the loan? What will the lease payment on this space be next year or a few years from now? What is my estimated annual rate of return? And is this investment really worthwhile? And many more, right? So to take a big step back, I think one of the best ways to think about the time value of money is to think about a lottery example. So first and foremost, let's just hypothetically say that you were playing the lottery and you won. So let's say it's an obscene amount of money, this amount of money that you could never spend in your lifetime. But the challenge, the complication, is that you have to wait 100 years to get it. So my guess is if you just found out you won the lottery, you would be ecstatic. Like you would be the happiest you've ever been, thinking about all the people that you could help, thinking about all the dreams you could accomplish. But if I told you you had to wait, I'm sure your feelings would change, right? Maybe something like this. You start to think about all the risks associated with waiting. Risks like, am I even going to be around 100 years from now? Is the group or entity that promised me the money, are they going to be around 100 years from now? What is the money going to be worth 100 years from now because of inflation, right? And so as we think about all these risks associated with waiting, we start to believe that that lottery winnings is worth less today. We start to at least qualify that it's probably not worth as much. It's not worth as much because of all the time and all the risks that we had to endure. So that is one of the key principles of the time value of money, and in particular, one of the key principles of discounting as we find a way to translate the future to the present. So one of the things that we try to pride ourselves in real estate, and in finance in general, but in real estate in particular, is that we need to do a really good job of quantifying those risks, quantifying that time, and maybe more specifically, quantifying the discount that we need to make to compensate or approximate for that time and risk. So let's come back to the lottery example just to put some numbers to this. So let's say it's $100 million, but it's received 100 years from now. Again, we just admitted to ourselves that maybe it's not as attractive because we have to wait for so long, that conclusion probably signals that it's worth a little bit less to you today. So I'm sure I could ask you, right? Like, what do you think that's worth to you? And some people would say, look, it's worth nothing. It's 100 years from now, I'll be dead. Some other people would say, look, it's worth something, but is it worth a little more than $1? Is it worth $85? Is it worth $72.50, right? Like, what is this really worth today? This is where discounting comes in. If we were to discount $100 million for 100 years, at each one of these respective rates, we would get those dollars: $0, $1.20, $85, $7,256. So depending on how much you discount, you will estimate a lower or higher value today. And I think one of the best ways or corollaries or examples that we can give to kind of support this argument is, let's say that you were going into a store and you saw a sign that looked just like this, that it's 50% off, that there's a big discount on an item you wanted. If that item was $1 and 50% off, now it's 50 cents. So if we think about the impact that discounting has, what we're really doing is reducing the value of something, reducing the price of something, reducing the cost of something because of some event, some circumstance, or in this case, some risk or time. So if it holds true for lotteries, and if it holds true for you shopping at a store, it's gotta hold true for real estate. So let's take a look at another example. What if you have an apartment building that you think you can sell for $20 million 7 years from now? What is that worth today? So if we were to discount that $20 million collected 7 years from now, we could try to figure out what it's worth today. So if we were to discount at 5% per year, it's worth a little more than $14 million. If we were to discount at 25% a year, it's worth a little more than $4 million. Just like the lottery example, just like the retail example, the more you discount, the less it's worth today. I'll say that again, the more you discount, the less it's worth today. You are assuming that there's more risk. You're assuming that there's more bad stuff that can happen, and you need to discount more to make up for that risk. The more you discount, the less it's worth now. So if that's the thought process or the rationale behind discounting, the opposite is true for compounding. So what we're trying to do is to figure out what something is worth tomorrow or at other points in the future. So another way to think about this is trying to quantify the growth over time instead of the discounting. And I think a lease in real estate is the best way that we can exemplify this concept. So let's imagine that you have this office building. You just signed a lease with a tenant. So it's a 5-year lease for 5,000 square feet, $30 a square foot per year, 3% annual escalations. What is the lease rate going to be a few years from now? What about in year 3, right? How do we figure out what that lease rate is going to be? How do we figure out what rent that tenant is going to pay us a few years from now? We're looking at the lease rate today and trying to project into the future, grow into the future, what we think those payments could be. So it's the same concept, right? We're just moving arrows in different directions. So $30 becomes $32.78 a few years from now at a certain growth rate. So just to recap, when we think about the time value of money, again, what we're really doing is trying to quantify, place a value on time as it relates to money, whether it's money collected in the future or money that we deal with today in the present. So when we talk about compounding or discounting, what we're really doing is trying to find a way to translate or equate present to future, future to present. So as always, I hope you enjoyed this video. I hope you learned something. If you have any questions, please feel free to reach out. Otherwise, I'll see you in the next one. Thanks.